What if we sold the house in the city and moved up here?
Good thinking.
Could we retire even earlier? But what's the tax implication?
What if, say, the market drops?
Or what if we outlive our savings?
Let's get on a call with Maya at IG.
Of course, these are complex questions. We can explore your different scenarios in your personalized IG living plan. Now we're really getting to see how this plan adapts to life's changes.
Find out what a real financial plan looks like. IG Wealth Management, a plan for living.
Hello, everyone from coast to coast across Canada, and welcome to the IG Wealth Management's webinar, Don't Overthink It, the Fall Financial Playbook. I'm here with Philip Peterson, our Chief Investment Strategist. My name is Ashish Uttarid, Assistant Vice President of Investment Strategy here at IG Wealth, and I'm excited to be your host today. We welcome all of our valued clients and guests today for our fall update and our conversation. It's always a privilege to host sessions like this, where we can share insights and address all your questions. We are already looking at our Q&A, and it's already getting pretty full. So please keep those questions going. On behalf of all of our advisor teams here at IG and everyone who supports them, we extend our heartfelt gratitude for your continued trust and loyalty. We are here to support you in achieving your financial objectives, and sessions like today are designed to give you the confidence in our commitment to managing your finances with the utmost care. We are dedicated to helping you successfully navigate these very interesting times in our history. Thank you for being here with us. Before we begin, I want to take a moment to share a territorial acknowledgement, a small but essential step towards reconciliation. IG Wealth Management acknowledges that our head office is located on Treaty 1 territory, the traditional lands of the Anishinaabe, Dene, Dakota, Inuk, and Anishinaabe and Innu peoples, as well as the homeland of the Red River Métis. We also recognize that some of you may be joining us today from many places near and far, and we encourage you to spend a moment acknowledging the traditional caretakers of those territories. So let's take care of a couple of technical housekeeping notes just to ensure everyone gets the most out of today's webinar. On your screen, you should be able to hear and see me. If you're having trouble hearing or seeing me at any point, please refresh your browser or do a hard reset and log into the website once again. Alternatively, you can close everything out and try over. If you are joining us online in the On24 platform, you'll see a console at the bottom of your screen where you can access many useful resources and tools related to today's session. And if you would like to follow up with your advisor after, you can hit the IG icon button and use the request a follow-up, and an advisor will be in touch with you. For those of you joining on our YouTube live stream, the links and resources can be accessed through the event description in the video below. Although we are virtual today, we want this session to be as interactive as possible. The Q&A, as I mentioned, is your opportunity to enter your questions. And if you're using YouTube live stream, please log into your Google account and join the chat function. We have Pierre Benoit, our own VP of Investment Strategy, online to respond to your questions. And at the end of our discussion, we'll pick our most topical and answer them live. Lastly, should you wish to review today's webinar, a recording will be available for playback using the same link you used to register, and a copy of the presentation is available as well. Okay, let's get started. I am pleased to be joined today with our Chief Investment Strategist, Philip Peterson, for IG Wealth Management and Lead Portfolio Manager for the iProfile Discretionary Programs. Welcome, Philip. How are you doing this evening?
I'm doing great, Ashish, and hey, thank you for co-hosting this webinar. It's great to see so many clients come out to hear what we have to say about the remainder of this year and as we head into 2026.
Yeah, we called it the Fall Financial Playbook. I know you and I are both football fans, so when you look at the playbook and how you're planning for the rest of the year even 12 months out, let's go through a few of our predictions that we started off at the beginning of the year. I'm going to show our audience what we started with.
Right, exactly. And so what we do every single year for the benefit of everyone on the line is we sit down as a team and we plot out where we see the environment going over the coming 12 months. And so when we were here roughly a year ago, we start to put this together in the middle of October and it's released towards the end of November. There are a number of things that we had in mind, and a lot of it has come to fruition in one way or the other. And we can go through this list fairly quickly, but we had an early inkling that Trump was going to win as president of the United States. And that meant that we were going to see tariffs again. And so We had tariffs as a potential risk to the marketplace. We weren't as dour as some saying that tariffs would trigger a recession, but it was one of the known unknowns out there. Also, we felt that China was going to start to see a bit of a rebound in its economy as the stimulus that they have been putting into their economy would finally work its way through and show in terms of growth. And we've seen that. We also felt that central banks would continue to cut interest rates, both in Canada as well as in the United States. Now, Canada, we did see cuts earlier in the year, less so in the US, but we think that we can continue to see cuts going forward. So, and as well as seeing cuts in Europe and over in the UK. Short-term interest rates, as a result, we expected were coming down, and they have. Long-term interest rates have stayed relatively anchored to where they were a year ago. We haven't seen that much change. Equities, valuation was something that we were paying attention to, but as we always say, it's worth paying attention to, but it's not worth fixating on. And so we're at a level where valuation is full to fair in many areas around the world, but we'll talk about that in just a little bit in terms of what it actually means for portfolios. Earnings, though, were the key to the success for the markets in 2025. All the rest is noise, and really what it comes down to are companies generating profits. So we'll talk about that. But in general, yes. I mean, the results that we've seen through the first quarter and second quarter have beaten expectations. In fact, the second quarter S&P 500 earnings results beat expectations. 90% of companies actually, beat expectations with an average year-over-year growth rate of 11%. So it's something quite strong. Post-election, yes, there was going to be some uncertainty there. But in general, most of what we felt was going to characterize the markets, whether it be fixed income or equity, played through, except for one. And I think this is, Ashish, where we want to recognize areas that we perhaps missed or misunderstood the market reaction. This was with the appreciation or rather depreciation of the US dollar. We felt that the tariffs would have resulted in a flight to quality. We saw gold rally on that. We did see a little bit of bond price appreciation, but the one area that we thought would see appreciation that hasn't is the US dollar. And easy explanation on that is there's just quite a bit of negative sentiment towards the US dollar because of some of the policies that are coming out of the White House. But that said, let's move on to what we see now through the remainder of 2025 and as we head into 2026.
Yeah, and even on the US dollar, we've already seen that start to rebound very quickly. We're going to flip gears and we're going to talk a little bit about equity markets. And we'll focus first on valuation. Now, valuation is something that we do monitor, but we don't fixate it, like you said. Can you tell us a little bit about where we're heading and what we should expect? Our markets are all-time highs. What should investors be doing? How should they be positioning?
Exactly. And here we have two charts. On the left-hand side, we have the range of valuation as measured by the PE ratio for various markets around the world, the S&P 500 in the US, the TSX next. So the gray bar is the 20-year range, although we take off the top 5% and bottom 5%, because that can really skew the results. So to have a realistic view, this is really 90% of the observations over the last 20 years, and where, for example, the S&P 500 is currently, it is at the top end of its 20-year range, where it's been over the last 5 years and 10 years. And you can work around the world and see where valuation lies. So it is true. Oh, and the other thing I should mention, Ashish, is that when we look at it, again, to try and avoid skewing the results, we eliminate companies that have negative earnings or for whatever the reason might be. So we're only focused on those companies that have actual earnings. And as you can see, it is at the higher end of the range for the US and for Canada. But valuation, we also say, is a terrible predictor of short-term performance. It doesn't tell us anything about how a market is going to perform in the next 6 months, 12 months, or 24 months. It can historically give you a sense of what a long-term view might be, but you can't really plan for that today. So when we look at this, someone might say, the US looks very expensive, we should sell it. Well, then we get to the right-hand side, and this is why we say, look, it's important to pay attention to valuation, but we shouldn't fixate on it because that could lead you down the wrong path. Higher valuation is fine if companies are generating the results that are expected. And what that means is if you're paying up for a company, it should deliver on earnings. And the S&P 500, you can see on the far right-hand side, this is the profit margin. And the profit margin for the S&P 500 currently is sitting at around 11%. So we're looking at a relatively lofty level for profit margins, telling us that despite everything that's been going on, companies are managing through it. And so we're actually quite comfortable with valuation, not only in the United States, but elsewhere around the world. Yes, there are pockets that are cheaper. Europe is cheaper, and it's benefiting as a result of that. The emerging markets are cheaper and are benefiting as a result of it. But in general, we wouldn't be shying away necessarily from any area around the world based on valuation, because the corporate results are proving that the valuation is justified.
Yeah, and that really talks about our next kind of topic, which is manufacturing. So you have tariffs that are maybe fixated on the goods economy, but you have this capital expenditures, you have all of this money flowing into hardware. Let's talk a little bit about the manufacturing index and where earnings growth kind of follows.
Exactly. And I almost want to take a step back, Ashish, and just say, while we titled the presentation, Don't Overthink It, and yet we're inundating all of our clients with very detailed charts. The reason why is because with all of the headlines that have been thrust upon us over the past, call it 8 months, almost 9 months now, as a result of Trump winning the election, it can skew our view of the markets and of the economy. And so what we're trying to show is that, look, we continue to focus or double down on the data and forget about the headlines, because the headlines can take you down the wrong path. Coming into this year, if all you did was focus on the headlines, you would have been scared. You wouldn't have thought that the equity markets can deliver what they have. But if you focus on the data, it tells a different story. So on the manufacturing side, this is where we see some upside risk or upside opportunity, put it that way. Risk works in both ways, but let's use opportunity. So on the left-hand side, we follow manufacturing activity in the United States through a number of different measures, but one of our preferred measures is called the ISM Manufacturing Purchasing Managers Index. It's a survey of manufacturers in the United States, asking them, are you doing more business or less business on a month-over-month basis? So as you would imagine, we have seen that dark blue line hook a little bit lower since the announcement of the tariffs. Companies are still trying to figure out how to navigate this new tariff world. Yet earnings, which is the lighter blue line that does tend to follow manufacturing, has held up very well. Now we're starting to see some of the data that came out today on one survey and earlier in the week on another survey has been showing some improvement on manufacturing. New orders are picking up. Companies are getting back to the business of being in business. And so we see this as a potential to help drive earnings growth through the back half of this year and into 2026. That's a positive. The other one is where we are with respect to the index. It's at currently 48.7. On the right-hand side, when you're in that environment and you look at what the one-year forward return on the S&P 500 has been traditionally, it's quite positive. It's been averaging about 11% going back to 1950 when we're at this level. Now, there's a range for it, but as you can see, what it tells us is that, you know, usually when you're at this level, things can improve. And that improvement is reflected in the earnings growth and therefore reflected in stock price appreciation, which, you know, as we were chatting offline, Ashish, you know, we continue to hit new all-time highs for the S&P 500, and this is a good thing, and I think reflective of what we're seeing on the manufacturing and earnings front.
Yeah, we've been talking a lot about the U.S., but I would also remind our audience that we saw the effect of even an influx of fiscal spending in Europe. So Germany specifically is upping their NATO commitments. They've looked at their defense spending, and they're trying to increase as well. And their manufacturing was in a recession a couple of years ago, and now they're rebounding very, very nicely. And that's going to reflect and has already reflected in their performance year to date.
That's exactly true. And one other thing I would highlight as well, one other measure that we like to follow is actually South Korean manufacturing production and exports, and that has started to improve too. South Korea, as odd as it might seem, is a bellwether for the global economy. And so we pay attention to the data. It's very, very robust data that we get, very timely. And it too has indicated that things are improving. They're on the upswing as opposed to the downswing. So, you know, we can talk about sentiment, and there is a lot of negative sentiment out there, but it's not necessarily justified by the data that is in front of us today.
Yeah. Should we move on to where businesses are spending their money? So
Exactly, and I think this is another.
let's talk a little bit about the top 10 companies in the S&P 500 and where the dollars are going.
Exactly, and I think this is also a reflection of confidence on some companies to spend and some companies to invest. So when we look at the top 10 companies on the S&P 500, and you can see the list of them there, they're dominated by the Mag 7. Plus, we've got Eli Lilly in there and Johnson and Johnson, for example. The amount of spending that we're seeing on these companies is massive. So we've exceeded on an annualized basis or a 12-month moving average $300 billion. Now, it's not all going to AI, but you can imagine AI is dominating a lot of it, but some of it's also going into pharmaceuticals and healthcare and other forms of technology. This is coming from companies that are generating significant revenues and significant profits. And so this is very different from 25 years ago during the dot-com bubble and bust, where companies were spending money, not that they had earned, but they had received from venture capitalists and other funding that really they were bleeding it away. And I remember it was called, are you on the bleeding edge of technology? Meaning, you were just wasting investors' money on false ideas. That is not the case today. We're seeing significant dollars being invested coming out of earnings. And that is a positive sign, not only for spending in the U.S. economy, but this is being spent in other areas around the world. So again, we keep checking the boxes of, are there more positives and negatives out there? And yes, to this end, there's significantly more positives.
Yeah, in fact, the 4 largest hyperscalers, so Amazon, Microsoft, Alphabet, and Meta, they've raised their 2025 CapEx guidance by more than $70 billion collectively. And a lot of analysts are starting to think that they are going to spend close to $1 trillion in CapEx over the next 3 years alone. And if you think about how that trickles down to, the information economy that we have today versus the manufacturing economy that we're used to 50 years ago, those R&D expenditures should pay off in 5 to 10 years. It's very probable.
Exactly. So let's go on to the rest. So
yeah,
go ahead.
No, I was going to say, we talk about consumer discretionary. This is the area where tariffs were supposed to hit the hardest. And since Liberation Day, we've seen an opposite story. What are your thoughts?
Exactly. And there's a number of things at play here. So we've been hearing for a while the consumer is stressed, but it's not, again, showing up in the data. It's more of an anecdote than anything else. When we look at unemployment in the United States sitting at 4.1%, that is very, very low, and we would argue very healthy for the U.S. economy. Now, we can talk about the labor market. Yes, job creation is slowing, but the immigration policies in the United States are almost offsetting that. And so we continue to see a tight labor market in the United States. Wages are growing on average about 4% a year. That's positive. The consumer, as we measure it, is still healthy. And so here's an example of that, Ashish, that we like to refer to when we talk about it as a team. We are using the consumer discretionary sector, the equal weight in the United States. So consumer discretionary companies will be companies like a Target, a Walmart, a Costco, for example. Also other companies like an Amazon. So using the equal weighted index, it reduces the outsized impact of Amazon and its market cap that it has on the rest of the sector. So when we compare everything apples to apples, what we're seeing is a consumer discretionary sector that is hitting all-time highs. This doesn't say there's a lack of confidence in the consumer. This says that there's continued strength in the consumer. And this is what we're hearing. We have 2 quotes there by Bank of America and JP Morgan. This is what Bank of America, which is probably one of the best bellwethers for how the consumer is faring in the United States because of the retail customers that they have and the credit card exposure that they have. And they're saying there's not an issue here. We're seeing continued strength out of the consumer, and that is a positive for the U.S. economy.
Yeah, we're continuing to see even record-breaking stock performance. American Eagle up 35% just in the last couple of days. It's quite astonishing.
Exactly. So, and that's a good thing too. We'll get to it in a little bit, but we're starting to see broadening out of the market. It's not just the Magnificent Seven that's participating. We're seeing other companies being recognized for their success and their profit growth.
Yeah, let's shift gears. We get a lot of questions about the U.S. dollar. We teed it up earlier with, our call that the US dollar would likely have a little bit more of an uptick at the beginning of the year when tariffs created volatility. And yet the US dollar still is strong. It's the supreme currency. What are your thoughts on the US dollar and where it's headed?
Well, exactly, Ashish. The U.S. dollar still is the go-to reserve currency of choice around the world. There has been talk of a BRIC currency, Brazil, Russia, India, China, and South Africa, having their own reserve currency, but it's still a long way off from materializing in any meaningful way, or displacing the U.S. dollar. As we can see here, the U.S. dollar is still used in a vast majority of transactions, whether it's just trade, commodities, FX, currency reserves by foreign central banks. And so it will be a long while before the US dollar is displaced as the reserve currency. Could it be? Absolutely. We've seen changes in regimes over the last couple thousand years. And so I think it would be naive to say, no, the US dollar will forever be the reserve currency. But I think it's too early to say that it's headed down. And in fact, when we look at where we are on the US dollar measured by the DXY, which is the basket, the US dollar against a basket of currencies, including the Canadian dollar, the Swiss franc, the Japanese yen, and the euro, it's actually right in line with the level where it was in the late 90s. And I bring that up because we'll be talking about, maybe comparisons to where we are today to the late 90s in just a couple of slides.
Yeah. This is the kind of the segue to like, what should clients do, or what should investors kind of look for? And Pierre Benoit said something amazing last week, is that the burden of proof lies with the bears. So let's talk a little bit about sell signals or buy signals. What are your thoughts?
Exactly. We've had some comments from clients over the past couple of weeks saying, I'm nervous about this market continuing to hit all-time highs. It's too rich, it's too high, it's too elevated, whatever it might be. And the concern is that we're due for a pullback. Now, first thing we have to pay attention to is, yes, we could see a pullback in September, but this is unpredictable. And the reason why I say we could is because historically September tends to be the weakest month of the year. We have a 55% chance of seeing a negative return in September versus a positive return. The average return is about negative 0.5%. And so September being the worst month of the year, can it become a self-fulfilling prophecy that we see volatility and we have a down market? It could. That wouldn't be out of the norm. Is this something that we try and get ahead of? No, because a correction is normal and often healthy for the markets. What we typically want to avoid when we're thinking about asset allocation is a severe shock or bear market. We could talk about what we did in the fourth quarter of last year leading into Liberation Day this year in just a little bit. But in general, we shouldn't fear strength in the marketplace. Strength in the marketplace leads to further strength. We can see on the left-hand side, this is the year-to-date chart, or rather, 2-year chart going from 2024 through to August 2025. And you can see the sharp decline that came in April, or let's say post-inauguration to the second week of April, that kind of transpired through the so-called Liberation Day in the United States. And then as President Trump removed or put a pause on those tariffs temporarily, we saw a rebound and the market has hit new highs. On the right-hand side, we've gone back to 1970 to look at, does an all-time high tell us anything about the forward return in the market? And the short answer is no, it doesn't. Here's some of the data that we found, is that the 1-year forward return from an all-time high, which happens at approximately between 7 and 8% of the time, going back to 1970, or 968 all-time highs since we put this slide together about a week or so ago. The average 1-year forward return is 9.5%. When we measure the average 1-year forward return for any other day, it's 9.5%. So we don't have any more risk to the downside. In fact, when we looked at the probability of downside 1 year later, so what's the probability of being down negative or having a negative return in the coming 12 months following an all-time high? It's 25%. It's 24% in any other peer. So statistically, there's no difference. So we shouldn't fear an all-time high just because we're there. If anything, we believe that we should embrace it. And because of all the data that we've talked about. Go ahead, please.
Yeah, no, and that's exactly one of the reasons why we push for diversification, right? So just because there's an all-time high in a specific market or a specific geography, being diversified allows you to participate in all of those things. The other thing too is we can't time the market, right? So everyone hears it all the time. It's a marathon, not a sprint. But the reason why we say that is because we would have never known what the bottom was in April, and we can't predict what the top was at all. And so having that insight allows you to stay invested and just kind of rebalance, look at all of the factors, and always revisit your investment plan.
Exactly. Now you say that, Ashish, and we know that you can never perfectly time the markets. And as we led into this, we said, look, there are no good sell signals, but there are good buy signals. And I think that that is a great lead into the next chart that we have, which shows where strength in the market doesn't tell you anything. So, for example, we have on the left-hand side here, on the top part, we have the S&P 500. And you can see, yes, we've hit new all-time highs. In fact, today we're over 6,500 on the S&P 500, higher than where we were when we put this chart together just a couple of weeks ago. The bottom half of that chart, though, shows breadth. And the way we measure it, we can measure it in a number of different ways. But in this way, we're measuring what what is the percentage of companies that are sitting above their 200-day moving average. So that is, if companies are hitting a new high, or what level are they above their rolling average over the course of the last 200 days, which is close to a year. It's not quite a year, but close to a year. And we're seeing right now, we're over 60% of companies on the S&P 500 being above their 200-day moving average. And that has actually been increasing since April. And this is a positive sign. Now, when you see anywhere between, say, 60, 80, 90% of companies above the 200-day moving average, that's a sign of strength. And if you follow along the chart on the light blue line on the bottom, look at what the index did during these periods. It continued to trend higher. Now, when we start to see that breadth narrow and come down, that's when you could expect a little bit more volatility. And then the buy signal is when it falls below 20%. That 20% level, if you look at where we are in history over that 20% level, you can see near bottoms or bottoms of the market. That is one of the many things that we look at when we see volatility to signal that we could be nearing the end of the volatility. That was one of those things that we saw this past April, along with many other measures that we follow that said, okay, we never know if we're actually at the bottom. You only realize that after the fact, but you can get signs that we're close to it. And April presented us with a number of those signs that were close to it. And what we were doing inside of our portfolios is adding to equities during that time period to take advantage of that low-end volatility that resulted in what we've seen, since then, which is the upside from, let's call it April 8th or April 9th to where we are today. And then on the right-hand side, we have the equal weighted S&P 500 along with the market cap weighted S&P 500. And you can see they don't always follow along the same path, but there usually is a catch-up. The equal weighted, again, measures all companies equally. And as the market broadens out in terms of strength, you tend to see a catch-up, and that makes for a healthy market.
Awesome insights. And that kind of we'll go back a little bit to seasonality. We talked a little bit about it earlier. And what we have here is the current year month-over-month returns of the S&P 500, which is your largest market, and the month return versus the average. And so you can see that September is actually, a weak time for market returns. What are your thoughts on seasonality, and how could that provide an opportunity? We got a couple of questions coming in about, yes, we love to have buy signals, but we also have retirees on the line as well. Like, how can they handle the volatility as well? What are your thoughts?
Great. Well, and it's a great question. So first, whether you're in retirement, approaching retirement, or early on in your investing life cycle, a balanced portfolio, I think, always serves everyone well. Now, the level to that balance, I think, is a great discussion between you and your advisor, as I have that discussion with my advisor. But that balance allows for allows us to take advantage of these opportunities when we have volatility. And let me explain what I mean there, Ashish. Often I'll be asked by some saying, well, I'm young, shouldn't I be 100% equity? Well, there's pluses and minuses to that. The plus is that, yes, over the long term, equities they outperform other asset classes. But over the short term, if you're 100% equity and you run into volatility, you don't have the opportunity to take advantage of it, meaning to buy in, unless you have cash or access to cash outside. But in a balanced portfolio, whether it's 70% equity, 30% fixed income, 60-40, whatever it might be, that fixed income allocation allows you to rebalance into cheaper equity valuations throughout the year or throughout the market cycle. So when we think about, how do we take advantage of it? Even a retiree will have some equity exposure, and even a retiree can take advantage of it by shifting some of their fixed income into equities to take advantage of that cheaper valuation and benefit from that upswing, which inevitably we will get, as we've seen almost 100 years of equity market performance in the US.
Yeah, I always tell clients, like, you wouldn't drive a car without shock absorbers. So why wouldn't you have a little bit of fixed income in your portfolio at the same time, even if you were a long-term investor?
Exactly. And I've always, as an investor, I've always had fixed income in my portfolio just for that very reason. So I always have something that I can sell to buy equities when they're cheap.
Yeah. So let's move on to kind of our final slide. We're going to summarize everything for you. While you're summarizing everything, I'm going to go into the Q&A and try to pull out some questions. So I'll pass it over to you.
Certainly. Throughout this presentation, the one thing you probably haven't heard us talk about a lot is the tariff impact. And that is a headline event. There's a lot of negative sentiment out there, and I think it's more media driven or what we're receiving on our phones or TVs or radio or whatever it might be, because it is all skewed to the downside. But that's not necessarily what we're seeing in terms of the economic data. Now, there are pockets of weakness. We saw in Canada, for example, second quarter GDP came in at a contraction of 1.6%. If you balance out the first quarter and second quarter, it isn't that bad. And why I say that, balancing it out, is because in the first quarter, in anticipation of the tariffs, a lot of companies pulled forward their orders. And so we saw exports jump in the first quarter and then slump in the second quarter. Now, where we go from here, I think will be a little bit more normalization as we work our way through the tariff tirade, if you want to call it that. Yeah. And so, we don't think it's going to be as meaningful of an impact on inflation, for example, or on the economies in Canada or the United States as perhaps some feared at the start of the year. Is it resulting in a slowing of, say, for example, the Canadian economy? Yes, but we can work through this. We do believe we'll work through this. And then as far as inflation goes in the United States, what we're hearing from companies is that they're going to be passing on the majority of the tariff impact to their consumers. And so it will result in we believe, modestly higher inflation, but not meaningfully higher inflation. And so the difference is, we could see inflation in the United States. It's at 2.8% currently. Could it get to 3? Yes. Could it get to 3.5? Yeah, I think it could stretch that high. But are we talking about 4, 5, 6% inflation? No, highly unlikely. And similarly in Canada, we're not likely to see that. So we just came through the second quarter in the US. We saw a GDP growth of 3.3% with inflation at 2.8. That's a decent environment. If we went back 30 years ago, that's exactly what we would see for the US economy. And so the economic risks, when we look at manufacturing, it looks like it's starting to improve, not deteriorate. When we look at housing in the United States, confidence is starting to build with the home builders. And even though the 30-year mortgage rate, which is let's call it the default or the go-to mortgage rate in the United States, it still is rather elevated, between 6 and say 7%. Again, we go back 30 years, that's normal. That's exactly where it was in the past, and maybe it's likely where it's going to settle in. We're starting to see housing starts pick up in the United States. This is strong for the U.S. economy. It's also good for the labor market. Housing starts, as they improve, drives consumption. And the consumer, as we've seen, remains healthy. So the economic risks lean to the upside. We think the risk of recession in the United States, which is more important than Canada, is very, very low. Now, Canada, could we see a technical recession if we get another quarter of GDP or negative GDP growth? Yes, we could. It wouldn't surprise me. But that doesn't impact the stock market in Canada or elsewhere around the world as much as a U.S. recession does. Our stock market is more geared towards global commodities, gold, copper, oil. our banks, which generate a significant amount of their business from the United States, and then other companies. So our stock market is not as levered to the Canadian economy as we like to think. It's actually more levered to the global economy, or certainly the U.S. economy. So the risks or the economic realities are more opportunities as we see going forward. When we think about then the markets, and I'll tie in the second and third points here, tariff noise has driven sentiment to a negative level. When we look at the investor sentiment in the United States, it's more bearish than bullish. But Sheesh, you pointed out, our colleague said very, very cleverly, the onus is on the bears or the burden of proof is on the bears, I think is exactly what he said. And that is the case. I have plenty of evidence why we're not headed towards the worst case scenario and things can actually improve from here. There's very little evidence to say that things can get much worse than they are, and they're not bad at all. And so from the market perspective, when we hit another all-time high, like we did today or close to it today, likely to do that in the future, these aren't things that should be feared. These are things that should be embraced. So putting it all together in terms of what we've done, it has been a very active year for our sub-advisors and for ourselves. We came into 2025 more defensive, with that view that the tariffs were going to be a headwind to stock market performance. We got that volatility from, say, January through till the first couple of weeks of April. Once we started to see that volatility manifest itself and to its full potential to the downside, then we started adding back into equities. And we've continued to add back into equities over the past couple of quarters to take advantage of these strong earnings, strong profit margins, and upcycle that we believe that we're seeing in the general U.S. as well as global economy.
Yeah, and it's not just equity returns. It's also cash balances on these large corporations, buybacks. Those are all positive for increasing equity values over time. We're going to move over to the Q&A portion, and we've got some really good questions. I'll start with the tariff one because, we talked in our last webinar, which we had at the end of April, about the tariff impact. And we saw almost within days of us having that webinar that these delays, or I guess you can call it postponements, started to happen. And they've been rolled over a couple of times now. We're heading into the fall. And the USMCA is in effect for most, if not almost all of Canadian goods passing through our North American borders. And you have kind of a softer stance on Chinese tariffs. So in light of all of this, do you still believe that over the next 6 to 12 months, the tariff impact, we know it's going to have an impact, but is it going to have a significant impact like we were thinking even just 6 months ago?
Exactly. And I think that's the difference. Significant impact is the key word there. Yeah. So what it looks like, Ashish, as we've talked about this in our team meetings, is that there's going to be a permanent level of tariffs in the United States on countries around the world. And that's going to range from, say, 10% to 20%. And we get that because that's what we've been seeing with the deals with Vietnam, South Korea, Japan, and the like. Now, the question is whether the Supreme Court is going to uphold the ruling from the lower court that the tariffs engaged using the IEEPA are legal, which are the tariffs that Trump has imposed, say, for example, on Canada for the fentanyl emergency and so on. That'll be very, very interesting to see what happens there. The legal experts say and suggest that the Supreme Court will knock them down, but who knows? We don't know at this point. We have to think this: if they do knock them down, there are other means that the current administration will employ to impose tariffs in one way or another. So a permanent tariff somewhere between 10 and 20% is the most likely scenario. Now, we can call it a tariff, but maybe it's a stealth consumption tax is really what it is, because what we're hearing from companies, again, is that they're going to pass it, the bulk of it, if not all of it, onto the consumer. And so the consumer is going to be paying this as like a GST, but a hidden form of a GST or some kind of value added tax, but they're calling it a tariff. Is that going to be disruptive? Probably not. This companies, again, have ways of managing through this, and they're driven by the profit motive and will continue to be driven by the profit motive. So we don't see a significant impact in terms of inflation, in terms of any negative economic headwind. In fact, once we know what it is, and this is the thing, it's not that the markets are concerned about tariffs. The markets hate the uncertainty around it. So once we have a certain path forward, we can get past it.
Yeah. We got a question on gold. Where do you think the rally, if it does end at all, or do you still see some legs on this?
Yes, and it's a great question. And so clients that have dialed in the past know that we have been bullish on gold for a couple of years now. The way that we measure gold, we would say that gold is at fair value, maybe slightly above fair value. But we also know historically that gold doesn't stop at fair value. It tends to continue to rally through that. And so it can go higher. Now, I don't want to put a target on it because, if I'm going to be true to our fair value, we're there. But, could it see 4,000 or higher than that? Sure, it could. Would I be surprised? No, I wouldn't, because the historical patterns of gold would indicate that, yes, we're going to continue to see this rally go. And just the other day, we hit another new high on gold. And so I don't think we're done with this rally yet, Ashish.
No, I would agree. And again, it's one of those diversifiers, right? You're not going to just have equities in your portfolio. You're going to have fixed income. You're going to have some commodities. You'll have private equity. You'll have other aspects to participate in all of those growth areas.
Exactly. And I should point out, I should add that we do own gold in our iProfile portfolios.
Yep. There's, I think it's a bit early to call AI a bubble. And we did have the privilege of going to Boston last week and talking with a lot of our sub-advisors. And a lot of them also agree that it's not a bubble territory yet. And if you think about it, in the early 2000s, when the internet was being born, you had lots of companies that were pouring lots of money into infrastructure and building out, what their businesses were going to look like. That's kind of where we are right now with AI. Now, this could take 3, 4, 5, 6 years, and you're obviously going to have several winners in this game. But right now, we're in the space where we're trying to identify who those winners are and see what dollars they're putting behind that. So, what are your thoughts on AI being a bubble?
Well, I think that, and this comes back to what I mentioned a little bit before, which is there are some parallels between what's happening right now and what we saw in the mid 90s. And it's quite exciting. So with AI, as you know, Ashish, we're using it in our day to day to help us be more productive. And we're only in the infancy of what it can do. So it's a real technology. Obviously, we've seen it. I'm sure a number of people on the call have used it in one way or another and have seen the benefits of it. And as it continues to develop, I think it'll contribute significantly to productivity. So if you think about, let's go the last 40 or 50 years, the real productivity leaps came with the PC, where all of a sudden we can do complex calculations on a computer and data mining and so on very easily. Then it became the internet, which did lead to a bubble, ultimately that burst in March of 2000. But that created, before that bubble created massive productivity opportunities. And now I think we're at another one with AI and the applications of it. Are we in a bubble for it? No. I would argue that we're not. We don't have companies that are generating no earnings, no revenues, but have a great idea like we saw in the late 90s. In this case, we have real companies like NVIDIA, Amazon, Google, Meta, Microsoft. You can talk about others that are revenue generators and investing in this technology. And ultimately, we don't know who the winners and the losers will be, but we're not seeing the same kind of euphoria in this area that we did, say, 27 years ago.
Yeah. Shifting gears a little bit, on the other side of the balance sheet is interest rates. So we have a lot of Canadians on the call. Many of them are in the middle of renewing mortgages. I actually helped my cousin with her renewal just last week. And where do you think interest rates are headed? And let's focus a little bit on Canada and then kind of what that translates to for the Canadian US dollar. What are your thoughts on that?
Yeah, and we have to come at it from a couple of different vantage points. First off, we do think that the Bank of Canada is going to cut in September. We think that with the GDP, the contraction in our GDP in the second quarter, that will allow them a justification to cut the overnight rate from 2.75 to 2.5%. It might get a little tougher, though, cutting deeper than that. And the reason being is that when we model out inflation in Canada, we do see inflation actually trending a little bit higher. So inflation is just sub 2% right now. But the way that inflation is calculated, where it's a year over year number using the month over month, linking them, we're going to see inflation likely trend up. Now, this is more a math problem than an economic problem, but the Bank of Canada will want to see inflation settle in at their target of 2% before they cut any deeper. Now, historically, the overnight rate would sit 0.5% to 1% above inflation. So in order to get inflation below 2.5%, the bank would probably want to see inflation settle in consistently at 1.5%. That might be deeper into 2026. So for now, we have one rate cut going from 2.75 to 2.5 coming in September. We'll see how the economic landscape plays out in the third quarter. Maybe it prompts the bank to cut once more before the end of the year, but I think more likely it'll be sometime in 2026 before they would be comfortable enough to cut again. In the US, as we've been following all the drama that's been going around with the Fed and the White House, we think that they will continue to cut. They're very, very likely to cut in September. I think there's a better than 80% probability being priced in the market that we're going to see that. Coming back on the mortgage question, though, Ashish, mortgage rates are set based on the 5-year and 10-year Bank of Canada, not Bank of Canada, the government bond yield. So here's where we don't see as much relief coming. We think long-term interest rates are likely to remain anchored. So in Canada, that's say between 3 and 3.5%. In the US, it's probably 4.5%. And so we don't think that we're going to see the long end of the yield curve come down in any meaningful way. It's more likely to result in a steepening of the yield curve as the short end is reduced, long end stays where it is. There's a benefit. We often say, okay, so what, big deal? That actually means that we could see the banks enjoy higher profitability into 2026.
Yeah, thanks for that. Our next question comes about confidence in U.S. data. We've hear a lot of noise about, indicators and market surveys. And my thoughts are more about more of these agencies have to leverage technology in order to get more accurate and live data. I think the way of doing business in the last 20 years has to evolve. And so we saw a little bit of noise with the U.S. administration, discounting some of the labor statistics. What are your thoughts on what should we expect going forward? Well, it looks like your audio muted out. Yeah, I can't hear you. But no, that's okay. We'll get you sorted out. But yeah, my thoughts on the labor statistics and any other of those things, we really need to focus on what is reliable data. And one of the things that we can rely on is the U.S. does have a good base of economy. They have a diversified economy. And so as long as they continue to do these surveys and publish these results, that's all a good thing. At the end of the day, businesses also have their internal data, which they also publish on a quarterly basis. So there's always a real-time data. I don't think investors really pay attention to any of those indicators, but as portfolio managers, we do. And so we're hoping that eventually all of that becomes, a little bit more streamlined. What I'll do is we'll end it there. I would love to thank everyone for sharing their expertise and their insights with us. Thank you for everyone who has tuned in today. If you would like to follow up on anything that we've discussed, please reach out directly to your advisor or request a follow-up meeting by clicking the IG icon below. If you're joining us on YouTube, click on the link event description and you can find an advisor near you. Should you wish to review today's webinar, a recording will be available for playback using the same link you used to register. And I would like to thank everyone for joining us today and have a great evening. Thank you very much.